On June 22, 2026, South Korea's KOSPI closed at a record high of 9,114.55. 4 weeks later, at Monday's close on July 20th, it stood at 6,516.27. And while that was happening, analysts were raising their earnings forecasts. That's the South Korea stock market crash of 2026 in 3 facts. And the third one is the strangest. Merit Securities measured KOSPI forward earnings estimates up 7.93% between the June 22 peak and their July 8 note. On that same snapshot, the index traded at 6.25 times forward earnings, below the 6.27 times it touched in October 2008, at the bottom of the global financial crisis. So the earnings estimates improved while the market collapsed, and leveraged investors got forcibly liquidated in the middle of it. Being right about earnings protected nobody. I'm Lockwood, and this is the Wealth Terminal. One decision today. Should a U.S. investor buy Korea exposure now, unleveraged, through a fund like EWY, wait until the forced selling measurably clears, or skip this market entirely? By the end, you'll have the structural mechanism that made being right irrelevant, an honest read on whether those forces have finished, and a 3-door framework. Buy, wait, or skip. 2 warnings before the tape. First, that 6.25 times figure belongs to the KOSPI index. EWY, the fund you'd actually buy, doesn't trade at it, and the gap between the two is one of the most misunderstood parts of this entire trade. That's coming. Second, the number that finally decides which door is yours isn't a PE at all. It's a test we'll run near the end, and it's about you, not Korea. We'll get there. Here's the tape, dated because this market moves too fast for undated numbers. On June 19th, the KOSPI printed a record intraday high of 9,385.59. The record close came on June 22nd. Then July arrived. On July 2nd, KOSPI 200 futures fell at least 5% and stayed there for a minute, tripping the sell-side sidecar, a 5-minute halt on program trading. On July 7th, an intraday fall of more than 8% triggered the market-wide KOSPI circuit breaker, a full 20-minute trading suspension, the 2026 stress test nobody ordered. Understand what those tools actually do. They pause trading. They don't guarantee you an execution price, they don't prevent the overnight gap, and they don't stop a forced sale from completing the moment trading resumes. Then July 13th, down 8.95% to 6,806.93, under 6,900. That capped a 19.7% decline over the first 9 July sessions, the worst start to a July since 2000. July 16th fell another 6.37% to 6,820.60. And that day matters for a specific reason. It came immediately after a large rebound session. Monday, July 20th, dropped another 4.46%. Through that close, one secondary estimate put July's provisional decline around 23%. And I say provisional deliberately. July isn't finished, so any worst month in KOSPI history headline stays premature until the July 31st close. For scale, March 2026 fell 19%, reported at the time as Korea's steepest monthly sell-off since 2008. This year has now produced 2 of those. Earlier today, July 21st, the index bounced 3.56% to close at 6,747.95. And here's the fact that should properly disorient you. Even after the 9% Monday, even after the breaker, the KOSPI was still up 61.5% for 2026 as of July 13. This is a crashing market having a spectacular year. Both things are true at once, and your decision has to survive both. Now the paradox, because the upgrade you heard at the top wasn't a rounding error. The same merits analysis found forward earnings estimates up 11.31% over a single month. Bloomberg's July 9 series had KOSPI forward earnings estimates up approximately 170% for 2026 year-to-date. And as of mid-July reporting, consensus earnings for KOSPI companies had been revised upward for 17 consecutive months. 17. Through the crash itself, analysts kept raising their numbers, at least through the July 8 window that's been published. So if you want the South Korea market crash explained in one sentence, it's this. So much of the selling wasn't expressing a view on earnings at all, because a forced seller doesn't have a view. A forced seller has a margin call. Forced sellers don't read research. One honesty note before we open the machinery. Nobody has published a clean decomposition of how much each force contributed to the fall. What follows is what can be documented, with sources and dates, not a precise attribution. Force 1. Margin debt. Domestic Korean margin loan balances hit a record 38.63 trillion won on June 24th. Borrowed money stacked on top of a market that had already gone vertical. When prices fall, the broker calls. And if you can't post cash, your position gets sold at market, which pushes prices lower, which triggers the next account's call. A Goldman Sachs trading note in mid-July described exactly that. Margin calls cascading through leveraged retail accounts, with a wave of them liquidated outright. The cascade doesn't ask whether earnings are improving, it only asks whether you can pay. Force 2. The new machinery. And this is the part most people miss. Capital market rule revisions took effect on April 28, 2026, allowing domestic single-stock ETFs, including 2x daily leveraged and inverse products. On May 27, the first 16 single-stock ETFs launched from 8 managers, 14 of them long 2x and 2 inverse, tied to Samsung Electronics and SK Hynix, the two pillars of the KOSPI. Daily reset leverage promises twice today's move, not twice the long-term return. And to keep that promise, it must rebalance every single day, which means mechanically cutting exposure into weakness, typically near the close. In a volatile sideways market, that daily reset grinds value away, even if the underlying stock eventually round-trips back to where it started. And because Korean stocks can move up to 30% in one session, the regulator's own math says a 2x product can theoretically lose 60% in a single day. Now scale it. By July 15th, Samsung Electronics and SK Hynix made up 52% of the entire KOSPI's market capitalization, up from 34% at the end of 2025. So when people call this the KOSPI leveraged ETF crash, this is the layer they mean: mechanical daily selling, concentrated on the two stocks that are half the index, with a direct line into the whole market. Regulators have since stepped in hard, and one of their deadlines, about 2 weeks from today, sits at the center of the weight case. We'll get there. Force 3. The National Pension Service. A market estimate circulated that mechanical rebalancing could force up to 74 trillion won of selling by the pension giant. On July 1st, NPS Chairman Sung-Joo Kim publicly rejected that estimate on the record, calling it absurd. Treat this as exactly what it is: live tension. Rebalancing rules are real and mechanical. The size of any forced selling is disputed, and the 74 trillion figure is an analyst stress estimate denied by the institution itself, not a verified fact. Force 4. Foreign money. Foreign investors pulled a reported record of more than $100 billion from Korean equities in the first half of 2026, more than $30 billion of it in June alone. May set the record for monthly foreign net selling of KOSPI stocks, 44.71 trillion won, about $29.66 billion. Be precise with that big number, though. It covers 6 months, not just the crash weeks, so it describes a sustained exodus, not a July-only panic. Stack those 4 forces, and you get selling that is capable of overwhelming earnings in the short run. Not forever. But the short run is exactly where margin calls live, so the market got cheap. How cheap depends, annoyingly, on who's counting. Bloomberg's July 9th series put the forward PE at 6.35 times against a 6.82 times financial crisis comparator. Citi's July 16th snapshot said 5.8 times against the 6.4 it cites for the crisis. Merits you already heard from the open. 3 houses, 3 answers. Because forward PE depends on whose estimates, which basket, and which crisis reference you use. So anytime someone quotes you a Korea multiple, demand the provider and the as-of date, and remember, every one of them is a snapshot. This market repriced again today. Does a forward multiple below the 2008 trough automatically make this a KOSPI buying opportunity? No, and here's why. When the E in PE is being revised upward that violently, the multiple compresses optically, and if the semiconductor cycle rolls over, the E falls, and cheap uncheapens, without the price moving an inch. A very low forward multiple can mean a genuine bargain. It can also mean cycle peak earnings, fast-moving estimates, concentration risk, or a market demanding a fatter risk premium for the chaos you just watched. Cheap is a fact about the present. It's not a timing device, and it offered zero protection to anyone forced out this month. Now the fund plumbing. It's the part people skip, and skipping it is how you end up owning something other than what you thought you bought. This is what decides whether your career view survives contact with your brokerage account. 3 minutes. The EWY ETF, the default South Korea vehicle for US investors, tracks the MSCI Korea 2550 index, not the KOSPI. Different basket, ownership caps, currency translation, US trading hours, fair value pricing, and fees all sit between the fund and the index you've been hearing about. So never quote that 6.25 times as EWY's own multiple. The fund publishes its own metrics, and the two aren't interchangeable. What EWY actually is, as of the July 16th holdings file, 23.26% SK Hynix and 21.72% Samsung Electronics, with information technology at 52.27% of the fund as of July 2nd. Dozens of names on paper. In practice, you're buying two semiconductor giants with a supporting cast. On volatility, pin numbers to objects. You'll see scary volatility figures thrown around for Korea. EWY's own 3-year standard deviation was 41.10% as of May 31st, and that trailing window flatters the present. Because Korean authorities measured Samsung Electronics at 96% annualized volatility, and SK Hynix at 113% between May 26th and July 10. The fund's official stat hasn't fully digested July yet, and its two largest holdings just traded like lit fireworks. Two more pieces of plumbing. On July 17th, EWY's published NAV was $164.42, while its closing price was $162.54, a fund trading below the stated value of its assets. That happens in part because Korea's exchange is asleep during New York hours, so EWY's price becomes the live guess and premiums and discounts widen in stress. Know that before you place a market order. On costs, the expense ratio is 0.59%, and here's what that actually does. $164.42 up front, decaying at 0.59% compounded monthly for 10 years with zero market return, shrinks to about $155. That's $9.42 to costs. It's an illustration. Real expenses accrue through NAV while returns vary. But it sizes the fee honestly, real, modest, and nowhere near your biggest risk here. You're also not paid to wait. The 30-day SEC yield was 0.29%, and the trailing 12-month yield 1.01% as of June 30th, and what little it pays is taxable in a regular account. Then there's the won. The won averaged 1,527.30 per dollar in June, against 1,490.11 in May, and a weaker won shrinks the dollar value of every won-denominated asset you own. Two things to hold straight. EWY's published dollar returns already include that translation, so don't subtract the currency move a second time. And even with the weaker won, EWY's NAV total return stood at 67.22% for 2026 as of July 16. The currency is a real headwind. It has not yet been the story. So, has the structural selling finished? The honest answer is, not provably. And here's the evidence on both sides. Margin balances stood at about 34.7 trillion won on July 14, down about 10% from the June record. That's a decline, not a clearance. It's still an enormous stack of borrowed conviction, and no published threshold tells us what cleared looks like. Here's the date I promised. On July 16, regulators immediately suspended new single-stock leveraged product listings and banned advertising and event marketing for the ones already trading. They're tightening the liquidity provider premium and discount threshold from 3% to 2% during August. And around August 5th, the minimum deposit for new or additional single-stock leveraged positions rises to 30 million won, with required investor education expanding to 3 hours. Read that correctly. It throttles new leveraged money going forward. It doesn't unwind the leverage already in the system. Beyond that, the NPS question remains publicly unresolved, with no clean public gauge to watch, and foreign flows posted a record first-half exodus, so you'd want to see them turn, not merely slow. If you're waiting for evidence of clearing rather than pausing, this is the checklist. Margin balances falling further and then flattening. Leveraged product flows behaving under the August regime. Foreign selling abating or reversing. And ugly down opens that stop cascading into program halts. Today's bounce proves none of it. July already gave us a brutal down day immediately after a big rebound. Cascades pause. Then they either resume or they don't, and only the data tells you which. Which brings us to the test I promised, the one that decides your door before any valuation gets a vote. At the size you intend to buy, could you watch the position fall another 30 or 40% from here, on top of everything you've just seen, without selling, without margin, and without needing that money for anything else? Answer with your actual balance sheet, not your self-image, because that's the entire lesson of this crash. The investors carried out in July weren't wrong about Korean earnings. The estimates rose. They were wrong about their own solvency. Conviction is an opinion. Solvency is a constraint. The constraint wins every time. Door 1. Buy. Defensible if, and only if, you pass that test. Unleveraged, cash you won't need for years. Sized so another violent leg down changes your mood and not your life. You're knowingly accepting a fund that's effectively two semiconductor giants, a currency that can move against you, and structural selling that may not be finished. In exchange, you get Korea at index-level valuations that every series we cited puts at 2008 crisis lows, on earnings analysts kept upgrading through the crash, owned through a fund whose own numbers will track that story imperfectly. On lump sum versus phasing. Phasing in on a fixed schedule buys you fewer catastrophic entry outcomes at the cost of possibly paying up if the turn comes early. In a tape this violent, it's a legitimate regret management tool, and either approach works if the sizing is right. Door 2. Wait. Also defensible, on one condition. Define your evidence now, in writing, before your patience gets tested. Margin balances materially lower and stable, the August rules bedded in, foreign flows turning rather than pausing. If you can't name what would change your mind, you're not waiting, you're stalling. And be honest about the cost. Cheap markets can re-rate violently. The cheapest read of the 3 houses we cited came from Citi in mid-July, and waiting trades entry price for information. That can be a perfectly good trade. Just know you're making it. Door 3. Skip. Fully legitimate and frankly underrated. If 2-stock concentration plus currency risk plus this volatility regime exceeds what your balance sheet or your stomach can carry, no valuation obligates you to participate. Remember, this market was still up 61.5% for the year as of July 13th, even after everything you've watched. A tape that can do that in both directions is not a mandatory event. Missing a rally you couldn't have survived isn't a loss. It's a rounding error on a life. If you do proceed, 3 pieces of admin. Unleveraged only, no margin, and none of the leveraged wrappers in either country, because daily reset math in a chop like this eats accounts alive. Mind the account type, since foreign withholding and distribution taxes land differently depending on where you hold it. So check yours before the order, not after. And use limit orders. You saw what price and NAV did to each other on July 17. Into August, I'll be watching whether the new deposit and education rules actually shrink the leveraged flows, and what the margin data does next. That's the signal that this stops being a falling knife and starts being a market again. The question isn't whether Korea is cheap, it's whether you can own it in a way that lets you remain right long enough to get paid. If this breakdown helped you see the decision clearly, a like tells YouTube to show it to the next person staring at this same chart. And a subscribe means the next decision breakdown lands in your feed when it's ready. And the usual truth, stated plainly, this is educational content, not financial advice. So talk to a licensed professional who can see your full picture before you move money.